storm that will not end well for the global economy. Noted economist Jim Grant says central bank easing, ultra-low yields, and access to corporate and sovereign credit are creating what will soon be a regrettable situation. Jim Grant from Grant's Interest Rate Observer is with me now in an exclusive. Good to see you, Jim.
Thank you, Maria.
We've talked a bit about this in the past. What is this perfect storm, and how do you see this playing out?
Well, I looked at the screen today, Maria, and I saw that the U.S. Treasury is borrowing for 10 years at 2%. Now, a bond or a note is a promise to pay dollars, which currency is undefined. It is a state of mind. It's what the market will bear. It's what the Federal Reserve chooses to impose. But don't you think it's a little curious that in this particular moment in our financial lives, the Treasury is paying only 2%? For example, the world over, there's a contest by governments to cheapen their currencies. The strong currency is the old maid of world monetary affairs. Central banks the world over are going from ease to hyper-ease, and people we thought were extremely radical in their monetary predilections, like Ben Bernanke, are about to be outflanked by others still more radical. So the monetary revolution is devouring its children. And the principal support of the argument that Treasury and government yields ought to be 2 and 3%,
right,
is that there is a kind of persistent deflationary undertow in the world. The credit is contracting, that debt is, right? How is it then that corporations are floating record volumes of junk bonds at record low yields? About a dozen junk bonds came in the past 6 weeks at yields of less than 5%. They've taken the high out of high yield. They've taken the yield out of high yield.
Yeah. So I mean, why is that? I mean, what do you think the answer is?
Well, I mean, I can explain it this way. I submit to you that muscle memory is about the most important unrecognized feature of financial behavior. This is a new theory for you, and you can write this down if you like. Bond yields have been going down, bond prices have been going up approximately for 31 years. Over this, like more than a generation in a financial career. People are in and out in fewer than 31 years.
Right.
And I think people have come to assume that what interest rates do when they get up in the morning is decline.
Huh. And well, that's what they've seen for so many years at this point.
But yeah, so I say that this moment in interest rates is as intellectually or analytically indefensible in this way as were 15% yields way back when the CPI was printing at much, much less than that.
And yet we're all wondering if there's this rotation where money's going to start coming out of bonds and finding a home in the stock market. Now, on a practical level in terms of investment theory, you're bearish on bonds. You've said that the odds are stacked against bondholders. And so why are investors still pouring money into bonds as we have this tremendous run in the stock market? We're not seeing that evidence of the trade.
Because it has worked for 31 years. Look at what's happening. Never mind the amateurs. Look what the professionals are doing. PIMCO and DoubleLine are both unveiling closed-end funds that will buy junk bonds on leverage. It's not enough that they're buying junk bonds at near record low yields and near record low call protection. They're also applying leverage to this non-value proposition. I mean, it seems to me the world is enthralled to yesterday's idea being that interest rates always and everywhere decline. So old am I, Maria, that I remember distinctly that they went up once.
There's some debate about the Fed stimulus, obviously, and there's little debate about the fact that the Fed stimulus is propelling this market, because we're still sketchy in terms of the fundamental, changes in economic improvement. But let me get your take. Do you think it's all about where rates are in terms of this deal flow that we saw today? We said big deal, Berkshire acquiring Heinz. We said this big deal in the airline industry. What do you think is behind that?
Well, there is, I'm not sure about the valuations of those two companies, but I do know about the valuations of the securities with which these deals are financed. You can borrow in there's a mad rush for new loans to stock the so-called collateralized loan obligations, these vessels that hold the bank debt that finances such transactions as occurred today. They can't get enough loans. So as vacuums, we need stuff to fill a vacuum, so we need loans to fill the CLOs. So debt financing, credit financing is incredibly cheap and incredibly easy to obtain, and that might be a good reason to why these deals are coming now.
Do you think it continues?
Yeah.
Deal flow is going to pick up.
I think so.
I know nobody knows how this is going to end, but you've been a critic of the Fed's policy for a long time.
Since before the Fed was founded, actually. In 1912, I started.
But just the most recent stimulus, last couple of years, has really
I think
gotten you out.
The Fed is at war on the price mechanism, the most important single feature in our collective commercial and financial lives. You know, the Adam Smith's invisible hand, the Fed will have no part of it.
How does this end?
Badly. I wish I could say it ends soon, because it would be so nice to have something else to talk about. Certainly I'd begin to sound like a car alarm about this. But the Fed will not acknowledge that it is suppressing prices, that what it is doing is a species of price control. Interest rates are prices. And the Fed is manipulating them at the level, they're manipulating them on the yield curve, that is to say the relationship among these prices. And the Fed, under the very pretty phrase, portfolio balance channel, is herding people who maybe don't know any better into assets that may or may not be suitable for them.
Real quick, I know they said 2015. Rates are going to stay low till 2015.
Who says that?
Well, that's what the Fed said.
Yeah.
But do you think they're going to start unwinding QE this year?
I think the Fed's hand will be forced by circumstances. The Fed seems to think that it is in control of events. In fact, events will be in control of the Fed. And once something happens to force the Fed to tighten, the world we want to get in front of the Federal Reserve selling of these securities, which is amassed in this multi-trillion-dollar volume. So it seems to me that we can't know the timing. We can have a sense a little bit of the dynamics, which would be noisy.
That's a great point, and that's really what we're all focused on, because that's going to cause a market disruption. Yeah. Obviously, we're going to.
It'll be bullish for some and bearish for others, but it will be, as they say in the trade, news.
News for sure. Jim, always nice having you on the program. We so appreciate it. Jim Grant.